Apparently, the world is ending, and this is the topic I want to talk about for the next few moments. Because apparently, according to anyone that you care to listen to, the end of the world as we know it is coming and coming very, very quickly. But before I talk about that, I need to do the usual piece of housekeeping. Once again, everything here is for education only. There's no advice given whatsoever. Now, apparently, the world is ending because the Royal Bank of Scotland said it was, and they issued a missive to all their clients saying, sell everything, run and hide under your bed. I should also point out that in the interest of fairness, that this is the same Royal Bank of Scotland that almost brought the entire UK financial system to its knees, courtesy of its incompetence during the GFC. So one may read into their learned advice whatever one wants to. But I want to talk about the reality of what's going on and just reflect a little bit about current events. And there's a few points I want to make. The first is that noise is everywhere. And this is an unfortunate thing when we trade. There is simply noise everywhere. Every talking head, every internet blogger, everything you see screams advice at you. And it's important to realise that it is only noise. And once again, when you're confronted with noise, the only thing you can do is default back to the data. So why does everyone say the world is going to end? This is just a collection of markets that I observe and trade. And you can see it hasn't been a stellar start to the year. The main culprit, the main driver, let's use the appropriate term that everyone seems to cast them as. The bad guy in all of this are the Chinese and their market. The Shanghai Composite has taken a fair smack this year, but it's really only continuing on from the fair smack it took last year. And this is something that you need to be aware of, is that events don't happen in isolation. And we see a spread of pretty poor returns for the year to date. The best performing market, strangely enough, is the FTSE 100. But intriguingly, the FTSE seems to spend most of its time simply churning, so that doesn't really tell me anything. We sit somewhere in the middle, down about 7%, and Asian markets are the ones bearing the brunt of what's happening at present. In part, we're seeing an unwinding of the speculative nonsense that overtook Chinese markets earlier last year. So that's not unusual. It's not something you should be surprised about. Markets go up and markets go down. I'm always intrigued that people don't seem to realise this. It seems to come as a hell of a shock to people that markets can actually go down. Here's news for you. Price goes down. Sometimes it goes down very quickly. Sometimes it goes down smoothly. Sometimes it falls out the window. But markets are bidirectional. They will go up, they will go down. You simply need to be prepared for that and to be realistic about that as an event. And to show you this, it's sometimes best to take a step back. This is the problem with noise. Noise seduces you into thinking short term. You get caught by the gibberish. This is the Shanghai Composite, going back to early 2006. People talk about the boom that China had. The boom that China had in terms of its equities market was 10 years ago, when the Shanghai Composite went from 1,000 to 6 and a bit thousand, and then promptly retreated. That's when the real boom was. Post-GFC, it went nowhere up until early 2015. Then it had 2.5, 3 quarters of explosive mania, and now it's come back down. So you need, in these moments, to take a step back and reflect. And what we see when we look at the drawdown from the peak for the Shanghai, we can see that its maximum drawdown was actually in 2008, not now. What you're seeing now is simply a continuation of a failure to defeat that previous 2007 high. So you're seeing a continuation of pattern. It's also necessary to understand a little bit about the dynamics of the Chinese market. Chinese markets are not like Western markets. They have a much smaller free float, that is, a much smaller percentage of shares are able to be traded, and this creates problems. They also, it strikes me as an observer that Chinese regulators are feeling their way. Their equities markets are immature. So in many ways, they do appear to be making it up as they go along. And that's something to be aware of. That's something to have in the back of your mind as a little contextual element that puts a lot of what is happening into context. And this is the thing. Context in trading is everything. Events don't occur in isolation, they occur as part of a continuum or spectrum of history. And much of what is said about markets is said in isolation of understanding of these events. If we look at the S&P 500, you can see the remarkable recovery post the GFC. Market has channeled up, almost unbroken, since 2009. And you can see that last year it entered congestion and now it's dropped out of congestion. This to me is not the end of the world. This is simply the natural play of markets. This is what price does. And again, this rise needs to be viewed in context, and this current fall, this current poor start to the year, also needs to be viewed in context. $1 invested in the S&P 500 at the end of the GFC would now be worth just under $3. If my dodgy mental arithmetic serves me correctly, that's a compound annual return of over 15% per annum. That's a remarkable return. There has to be an expectation that sooner or later that would end. And this is the problem we run into with the bobbleheads on TV. They all suffer from recency bias, simply because they're not intelligent enough to actually understand what's happening with markets. They think that what happened yesterday is the only thing that has ever happened, and so should therefore happen forever. Well, that's not true. If you look back at the history of the S&P 500, since the end of the GFC, it's been an exceptional run. And you need to understand within the history of markets that runs come to an end. That's just the natural order of things. Our markets are a little bit of a different case. Our market has never recaptured its post-GFC glory, its pre-GFC glory, and we've ambled about in this very, very broad uptrend, and that I'm actually overselling that. It's probably one of the laziest uptrends I've ever seen. And the trajectory of our movement to relative new highs has been really quite difficult. And you can see the market congesting between 5450 and 5,000, and it seems to be stuck in that range. Again, history tells us what to expect, and it tells us to expect that our market has not performed all that well. Let me rephrase that because that's incorrect. Our broader market has not performed very well. And you can see we're still just struggling to recover from the GFC. We've not made a new all-time high. And that's an important feature of the market. It's important that markets that are displaying strength continue to make new all-time highs. That's simply a barometer of market health. It also raises the point in trading that your backyard might be completely irrelevant. And this is the issue that is, in part, central to what I'm speaking about. Simply looking at the domestic market is an irrelevancy. If all your system can do, or, no, let me rephrase that, if all your worldview is what's happening in the All Ordinaries, well then you've got a very myopic and very limited view. And as I've said before, if post the GFC you were buying Australian equities, you were largely wasting your time. You were trading a market that was not giving you the returns that your system could have given you. And I've spoken about this ad infinitum. We can see in this simple comparison between S&P 500 and the All Ordinaries The S&P to date up 140%, post GFC we're up 40. It's not really all that good. It's very mediocre, it's very modest. You need to think beyond your backyard. You need to think beyond those things you're being told, both to buy and consider. So your worldview has to be very, very different from other people if you want to be successful. And here's what I mean by that. I've taken this from a site called FinViz, and these are yearly returns. So these are year-on-year returns. And I've simply dropped off those that had shown a positive return, and you can look at this for yourself. You simply go to finviz.com. They're a few and far between. The big moves last year have come in commodity markets, and the biggest of those have come in the energy sector. And in part it is the collapse in the oil price that's giving people heebies, but for commodities traders that's a very, very good thing. What is really bad for the Saudi royal family is really good for commodity traders. And this is what I mean by looking beyond your backyard. Trends exist somewhere. So whilst equity markets might be rubbish, and remember, to generate a return from an equities market, it needs to be going up. The short selling of equity indices is very, very difficult and tends not to work as well as people think it might. So therefore, if you've got something that is trending and trending down strongly, and it's not in an equities market, you have the opportunity to trade that. However, all of this is predicated on being able to keep your emotions in check, to not throw all your toys out the pram, and to put your big boy pants on and have a plan. And this is key to any market activity. It doesn't matter whether markets are raging ahead, going sideways or going down. You must have a plan. You need to think rather than react. Reacting is a very base instinct and is not conducive to long-term survival or wealth creation. So the very simple missive and the very, very simple conclusion to this is no plan, no trade.